Welcome to the Texas Oil and Gas Podcast. Ryan right here. Josh Shelton had something come up, unfortunately, and he will not be here today. Should be back for next week. And so, in his place, we brought back the man who broke the internet last week, Robert Martinez. Robert, thanks for hopping on. Short notice. This came up yesterday, so appreciate you hopping on with us.
Thank you, Ryan. I appreciate the opportunity to come back here and redeem myself after the last week's conversation. So it's great.
Well, yeah, let's get into that real quick. So, there's two things that came up from last week. First
Oh,
off,
hold on. Before we get into that, let me say something. I think this is the quickest promotion I've ever gotten. Right? You go from being one level, and then you move up. Next thing you know, you're co-hosting the show. The show. Now, no disrespect for Josh. Josh. Our thoughts are with you and what you're going through back home. But maybe you've promoted me because, unlike my past opportunities and different working engagements, the new salary didn't have to come with the new job, right? Typically, they hold you back and they don't want to give you a raise because, oh man, I'm gonna have to pay him a vice president,
mhm.
which quite funny story. I've never been a vice president, so that's how that kind of works, right?
Yeah.
But yeah, all right,
Yeah,
let's
well, you
get
get
on
the
with
same
it.
pay that we paid Josh, so we'll pay you commensurate with his pay. No worries there, and
Awesome,
we'll,
awesome.
we'll we'll probably double it just for that because
Just
Christmas
just
season.
just to cover
Yeah,
everything.
holiday pay,
I
holiday.
gotta I gotta cover this camera, this new little fancy webcam camera that I bought. It still looks terrible, by the way.
No, that's
Uh,
pretty good. But there's
I had
two
a one.
there's two questions that really broke the internet last week. First, why are we not friends? I had people pouring in like, dude, why does Robert hate you guys? He wouldn't even say y'all are friends publicly. And two, we had a little back and forth over why you think the price is the fundamentals are strong on the price. The price right now is trending down this morning. I think everything's kind of trending downward. But so first, Robert, why are we not friends? And then two, why are you bullish on the price right now?
Well, I'd like to think that we are friends. If you're text messaging me, typically I consider you a friend because I don't like to give my cell phone out to people that I don't really like, unless you're a really angry interest owner that happened to get my cell phone from some bathroom in the library somewhere for some reason. That's happened before. Someone's written my name and number somewhere. That's terrible. Um, but yeah, we're friends. At least I thought we were. I bought you some hamburgers last time, and you didn't even much to say thank you. So
Wow. Oh, that's aggressive. That's aggressive.
I got to
I,
punch back, man. You can't be throwing jabs at me on the internet or the podcast or wherever the people are driving down the road here and me sit here and take it.
I'm
So
pretty sure I bought last time, but if I didn't and I didn't say thank you, okay, listen, I would have said thank you. Josh would have said thank you. That's the guy. He has no manners.
well, Josh just doesn't say much. He's pretty quiet, right? He's pretty quiet. It's magical for me to watch him on the show on your YouTube channel. By the way, if people don't know that this is actually ends up on YouTube,
Yeah.
and so you'll be famous that way, and you'll get to see how ugly we really are.
Yeah. Well,
But Josh didn't say much in person, at least when I'm around. And maybe he's just astonished at some of the crazy things I say. Who knows?
he doesn't.
But when
He
but
doesn't.
when he gets on these shows, he just comes alive, which is just
Oh,
great.
he's a bubbling personality.
Now
So
quit talking bad about Josh. I miss the guy. He's a good dude.
let's not get carried away. Let's not get carried away. So the other thing is the fundamentals. So we had people reach out and said, "Hey, I was." Some people liked your take on the price. Some people didn't like your take on the price. I didn't agree. I thought the price is overinflated. Any reflection on that, or you want to admit that I was right now, or how do you want to
Well,
handle it?
so here's like what you remember. One of the first things I told you: if anybody knows what prices are going to do, they're full of it, right? And so everybody's opinion is as good as mine or as good as anybody else's. You can get into the fundamentals, but one thing you got to remember when you're gauging somebody's opinion on market sentiment, what lens are they looking at things through, right? From what perspective are they seeing the way things are? Are they a producer? Are they a service company employee? Are they a staff engineer? Are they an investor, or are they an innocent bystander, right? So
Right,
those are all important lenses to look at, right?
right,
Uh, we in my company, Titan Rock, we're looking at the market as an acquirer, right? We're looking to acquire more assets. We're looking to pick up assets, right? And if the market truly believed that it should be much lower than where it is now, we'd see a lot more for sale, a lot more on the A&D market, right? It'd be a hot potato. Well, prices are going to drop like a rock. We need to go ahead and get this off our hands. And so there is not that activity, and at least for the last year, you're not seeing some of the activity. If you ever subscribe to BMO's, weekly snapshot, you'd see the number of deals per month and per quarter. I don't know that's going to continue to go, but it's going to drop. It's been dropping for 2 years now. So if people really thought this was a hot potato, you see a lot more in the market. Now, to be honest with you, we always talk about oil price, but what's really not happening here, we're not talking about the oil price curve, which is the fundamental difference here. we're talking about spot prices. We're talking about what the price is today. Right now, it's somewhere in the 47.30, but it's backwardated, which means that today's price of 47.30 is much higher than people believe the future price of oil. So I'm not saying it's going to go up. When we're talking about relative to the shape of the curve. So today it's 47.30, but the market and the forward curves show that it'll be down to 46 by the end of 2023. So that's a $1.30 movement from today to the end of 2023. That's not a lot of movement. So
Yeah.
now, is it going to be 50, 60, 70? I have no idea, but I'd like to believe that it would. But honestly, I think you set 70 is probably a bad thing for our industry, right? I think having prices that high is actually a bad thing for us.
Okay, so yeah, I'm glad you said that, because when I look at the price, and I've told you this when we've talked before, when you bought burgers, and I thank you, is that when Bloomberg puts out an article, price moves 3%. The guy on the rig, he doesn't care about that one way or another. What he cares about is the price, and I hate saying break even, but for this term, is the price above break even? Because if it's above break even, he gets to go home, he gets to have a job, things are kind of moving along, and as someone who's worked in the oil field services sector for so long, to me, that's really the big number is, are we above 50, 55, somewhere in that range? When you get below that, you start getting nervous, right? And
So again, one of
I'm,
my big, go ahead. Sorry.
honestly, so I'm looking at the price. I am definitely looking at more of a near-term price, because as the price, where it's at right now, you're kind of borderline. Some companies will work, some companies won't. If it goes down too far, the companies that are working will stop. And so for me, that's kind of how I'm looking at it a little bit more near term. I don't really look at the longer trend stuff, because I'm extremely bullish on oil long term. I think it's not going anywhere. How high will it get, I have no idea, but it's not going anywhere. And so how all that shapes out, I don't know. So it's interesting, because when you're talking about the price, you're looking at it from this perspective, and I'm looking at it going, okay, if I was owning a service company and we're planning our next 2 to 3 months, do we expect to see the price crash, or should we go hire a sales guy? That's kind of how I'm evaluating it.
So you're looking at it from you make a good point. One of my biggest pet peeves I see all the time in the news and in the media today on shows and on talking heads is that they're talking about break-even prices, right? And I think we've talked about this before at lunch. There's a difference in break-even prices, and I hope most of your listeners understand this. It's the capital break-even price, like the AFE break-even price. What does it take for me to drill a well and be profitable and make our economic hurdles, not just to make money, but make money for our investors, fully baked, including burdens and overhead and things of that nature, right? And then there's a break-even price, which is the operating expense break-even price, assuming the drilling costs are gone, right? So you look at the production in our country, you got a lot of shale, but when prices drop the way they do, it discourages capital spending. Well, what determines whether a company makes money or not, other than going through the debt, which is a big part of what's happening, is the break-even price for the producing wells. So there's two types of break-even. And the rig hand, which I've been on the rig, I've worked on a rig before. They're concerned about the break-even prices and the spot price today that's going to keep that rig moving. But you got to understand the business is much more than just the capital side of things. It's much more than the drilling and the completing and the fracs.
Yeah.
There's a whole other part of the business, which is in my opinion, the long-standing part of the business is once you're done drilling these wells, what do they turn into? Producers, right? Artificial lift, things of that nature, workover rigs to repair pumps. So that's a different type of break even, and that's a different price, that we're looking at. So, if you're looking at the A&D market right now, and for the last year and a half, nobody's buying acquisitions for the most part, other than acreage, big acreage positions, and paying upside. Nobody's paying for undrilled locations or recompletions or anything like that. It's essentially a PDP, producing, develop, prove, producing, develop. I just say PDP driven market, right? And that's what the buy and sell is happening. So, yeah, you're right. I think the capital part of it is one part of it, but ultimately it's profitability long term.
Right. So yeah. So it's not that I disagree with anything you say. I think that the reason we talked yesterday when I asked you to come on, we won't talk about this again, is that we're not necessarily talking about the same thing. We're talking about the price. Is the price overinflated, underinflated, too high, too low? How you're talking about it, I don't necessarily disagree with your analysis of what you're talking about, but what I'm talking about is not the same thing. And so anyways, I think that's important, because we've talked about that before on the show, where I hate saying break even, because as you mentioned, it doesn't really have a clear definition, and even if it does, it's different for each company. So I hate using that terminology, but by and large, when I'm talking about the price, I'm more talking about just where are we at right now today? How does it feel? Does it feel too high? Does it feel too low? Are we overinflated? If you went back in 2016, I don't know what the prediction numbers were in 2016 for 2017, 2018, but I doubt they were as low as they were as the price ended up being, until the market
Right.
start to fall. So the forward-looking numbers are kind of hard for me to gauge. But if you're looking at the numbers at the time, you could have seen that the inventory was building quickly, and so you'd been smart to say, hey, the price seems a little bit overinflated. No one
Well,
did, and
but in the back of the curve, though, if you look at it, it's starting to bank that and starting to mark that as you get out into out years, it starts to continue to drop. So even though today's spot price to some people might seem inflated, the out years have been coming down, and that's reflective in transaction prices when they sell. People typically look at the strip and slap that on the reserve database to transact. So just to tell you a little bit about what we're seeing, and I'm not saying it's going to go up or down. I'm just saying for us as a buyer, it makes sense to look at the entire shape of the curve and look at which way the wind's blowing directionally across the industry, including the international, right? And so our research is showing us that there's going to be a higher probability that you're going to have more demand and supply in 2022, right? I gave you the number for 2023, which was it 46?
yeah.
And so we're seeing that there's a higher chance that you're going to have more demand and supply in 2022. Yes, that could be dampened a little bit by the second strain of the COVID that's making the rounds. That's been out and about now. You're hearing about it now in the press. I heard about something like this about 8 weeks ago from a friend of mine that's really into the press. He works for a major corporation, a media corporation, and he said, "Hey, I'm hearing there's a second round of there's second strain out there that people are catching that's more contagious than the first, and now it's starting to hit the press today, and that could be dampening the demand. Right, it's going to push out the recovery even that much further. But even pushing into 2023, that's still 2 years out, and the companies of today need to be thinking longer term than 2 years out. Right, so
And I
too high.
agree. I agree. This is so you're looking at it from an operator standpoint. I'm looking at it from a service side standpoint. Well, the service company's got to figure out how to survive, from 2021
Yeah.
to make it 2022, 2023. And that's the hard thing is how do you survive and how do you do that? So anyway, so I want to get to, we have a guest coming on, Jay Young here in a minute. A few stories I want to hit real quick, get your take on them. So the rig count is up. I'm curious from your perspective, the rig count's up, whatever, that we talk about that anytime. How are you trying to gauge what the rig count means today? Because it doesn't mean what it meant. It's like, I wrote a piece for the War Room about a few weeks ago about the stock market and how many fewer companies there are traded publicly. And so whatever the stock market means, it doesn't mean what it meant back in 1996. So what does the rig count mean today to you? Like, do you look at the rig count and go, oh, okay, this is good, this is bad? Or are you trying to figure out what it's going to mean because we've had such a crazy year?
Well, as an industry, we're supposed to be practicing capital discipline, and that includes taking advantage of efficiencies, right, and scale. Um, the days of masking a company and fiscal performance by hiding behind a drilling rig are over, right? And they should be. Every well that's drilled needs to stand on its own and completely burdened. And if they don't, you don't need to be drilling them. And I think the investment community and PE understands that. So I think when you're starting to look at the rig count, it's not important just to look at the rig number itself. It's who's doing the drilling, right? Are we talking about private equity backed companies? Are we talking about small independents? Are we talking about public companies? Public companies has a different model and they look at things in the world differently, right? So a lot of these companies just don't need to be drilling them. But then again, I don't live in their world, so I don't see their economics of their wells. But based on the data that I'm looking at, especially stuff that's off the tier one,
Mhm.
the economics don't make sense at current prices, right? But that's their call. That's their,
Right.
they got to outrun the monster. They got to, private equity chasing them and so on and so forth. So
Is there a certain amount of rigs that, if you woke up next Friday and the rig report came out and would you be concerned, like, 20 new rigs, 50 new rigs? At what point would you say, oh my gosh, like we are really getting to the point to where we've got too many rigs out there and whatever the forward stuff means, we may drill this sucker down.
So we can't sell rig counts. All right. We don't make money by, just like I tell people in the field, I don't make money on pressure. I don't care if the pressure of the well is pretty high. That doesn't sell. It's oil and gas. So I don't make money on the rig counts, right? Looking at the rig counts is just an indicator. What I do make money on is the price of oil and the price of gas. And so this goes back to what we talked about earlier, is I'm looking at the oil and gas prices and I'm looking at the outward strip and how far out into the curve and what the movement of that it looks like, because that's actually trading hands. There's financial contracts trading hands on a daily basis, hedges, so on and so forth, based on exactly those numbers. So it's good to peek over at the rig count, and I do track the rig count versus the price of oil and gas.
Mhm.
But my primary lens into how this is going to affect us directly is going to be on the price of oil and looking out at the strip itself.
Okay. Speaking of the price, this was from Friday, I believe. Yeah. 7th straight weekly gain, closed above 49. As we said this morning, we record at 10 o'clock Central Time for listeners' perspective. It's down to 47. Um, as you mentioned, there's a new variant strain that's been talked about some, but now is getting some wind in the UK. They've had more shutdowns. I think it's safe to say we will not post an 8-week weekly gain this week, Robert.
Probably not.
I think you're pretty safe there. The shutdowns, it's weird because the shutdowns in the UK, and I haven't seen where else. I've been traveling this weekend, so I haven't got to follow too much. I know the UK had some partial shutdowns or lockdowns. Um, one of the things that I've talked about before on the show is we know what the bottom of the market is now. We know basically how low oil demand can go. Like we didn't really know what that was back in February. Everyone could have guessed, but we now know. So does that mean that maybe as you see the lockdowns, the price won't swing as wildly because people do know where the floor is?
Well, I think it goes two ways. It's not only that they know where the floor is, but also as far as COVID-19 is concerned, people know what it'll do to you. Right when this first happened, we had no idea how terrible this was going to be. We had no idea, is it going to take the lives of people in their 20s or 30s? Does it affect the kids? We didn't know anything about this virus. This reminds me of a couple years ago when we had the Zika virus. Everybody was freaking out over that, and then mosquito bites you, and what are the long-term impacts of that, right? And I don't fully know yet how that's going to affect us long term, but I think COVID specifically, I think people recognize that, okay, if you're within a certain age and a certain demographic, you're probably gonna be okay, right? You're probably gonna live. So I just think that the number of shutdowns, especially in the United States, being a free country, it's going to be a lot less. I just don't think we'll get back down to that level of lockdown like we had earlier in the year. Now, European countries and things of that nature, they have a different rule of government, rule of law, and they can impose those kind of things on their folks. And people, for the most part, can complain about it, but they comply. Here in the United States, I just don't see us getting shut down to the point that we were in March. So I expected that domestic consumption is going to either hold where we're at today, or it's going to slightly rise over time.
That's a good point. So the floor, and we saw earlier this year, is not even the floor now. Excuse me. Is not even the floor now. The floor is a little higher because we probably won't see the same level of lockdown. So we know what the floor is, but really it's like a false floor because it would be above that. So the prices are going to respond accordingly because they say, well, we're not going back down to that because people probably won't, the lockdowns won't be as draconian as they were in the spring.
There's much more to it than that, right? Though we're talking about lockdowns and demand, but you always have the X factor. Right? I don't know what you want to call it, but it's essentially what the rest of the world's doing. Middle East is always, OPEC and the cuts and the spare capacity, the Iran sanctions, and all those things. Those are wild cards, right? And so we can estimate what we think will happen, but you look what happened not long ago when Russia and was it OPEC or who got into a bind and they started flooding the market and down comes the price. So, I mean, those things are still out there potentially that can come back and bite us in the butt.
Yeah. Okay. Let's see. I think we got time for one more, maybe two more. Let's see if we get them quick. Demand recovery, signs of recovering demand boost prices for U.S. crudes. The demand recovery has been interesting to watch because if you look at travel data, from flight data or from driving data over the holiday season, it's down pretty substantial. I think over Thanksgiving week, it was down the lowest since 1997. The flight data, the single biggest flying day of the year was down 40% year over year. And so it feels like, hey, we're at the spot where the demand's up, but it's really not up relative to what it was last year. Are you concerned that maybe we're a little bit overly optimistic about the demand data because it's not as rosy as the stock market would have you believe, at least?
I think we could be, but again, it goes back to, and I'm only speaking specifically about COVID and the second strain. I do think that does exist out there. I don't, I'm not a doctor, so don't hold that against me, and I don't want to get a bunch of phone calls and saying that I think I'm the doctor, but I'm worried about it.
You come on this show, it's controversial. You gotta have hot takes. Go.
I am worried a little bit about the second strain. I do believe that there is some variants out there, just like any other, the flu has strains. That's why you get the flu virus and then, or flu vaccine. And then a couple of weeks later, you have the flu. So I think there may be something to that. And we still don't know what that is. But what we do know is that for the most part, most people are going to be fine. I've had several close friends of mine that've gotten COVID and, some of them healthier than others. And for the most part, everybody's okay. Now, that being said, I don't want to minimize that. I've lost friends as well and lost family members over COVID. But I'm just saying, generally speaking, their underlying risk factors and are different. So we kind of know what COVID is going to do to certain people. Now, there's always a surprise, right? Some young 25-year-old marathon runner, dies from it, and that's terrible. And it happens. But for the most part, we're not in a situation where we were in February or March where we didn't know what we didn't know. At least now we know. Okay, and some people are willing to take the risk more. I bet you that Christmas and New Year's holiday travel is going to be up, even though we're kind of an all-time high in some places in COVID cases, because people recognize it. Look, it's probably not going to kill me. I'll get sick and I'll live, and so they're willing to take that risk.
And up next, we have on recurring guest and a good friend of mine, a man who publicly acknowledges our friendship, a man who's taken me to places that I would never have gone without him. Of course, you're talking about my friend, your friend, the one, the only Jay Young. Jay, it's good to have you on the show again. How are you doing, sir?
Well, Ryan, I'm doing great. Thanks for having me again on your show, man. You're awesome.
Well, it's the least we could do for a friend like you, and so
I hear where you're going with that, Ryan. I mean, I really hear that.
I'm just saying, just making it clear. We're friends, right, Jay? Right? We're friends.
Absolutely.
Yeah,
absolutely. But now we got to meet our new friend, Mr. Martinez.
Well, me and Jay can quickly develop a friendship. Ryan, you and me, I mean, we got some mending to do here.
Well, it sounds like it.
It sounds like it. Well, Jay, real quick. So we were talking offline. So you and I went and toured. I was just your guest. You took me to a tour of the new Ranger Stadium before it was open. This has been a year ago, last October. I know I was taking you to the World Series. You were there. Just how was it? How was the stadium? I hadn't talked to you since the World Series.
Yeah, well, I tell you what. I mean, that is one of the most beautiful places on the planet. It really is an incredible place. But I mean, the weather is the best thing. I mean, man, I mean, how many Rangers, they never get any veteran pitchers because it's so hot in Arlington in July and August. But man, that's not going to be the excuse anymore. So I mean, I know they're rebuilding now, but man, you went when it was dirt, grime. We had to wear hard hats. I mean, it was, which is a great time. And I really enjoyed getting to see all the suites underneath and the club they're going to have underneath where you can go in there and eat, free. And it's kind of like, I don't know if anybody that had anything to do with AT&T has anything to do with this on the setup, but it's probably pretty much the same. I've been to a lot of stadiums, even, St. Louis and the card room or the card, I forget what they call it underneath the stands were the same thing with Cardinals, but St. Louis, but same thing. It's going to be incredible. But I mean, I haven't seen we were looking at the right behind home plate.
Oh man, those were nice.
Man, I tell you what, you're right there next to these people, right next to the Rangers, and I haven't seen a game from down there yet. They didn't have those during the World Series, but I went to the National League Championship Series, Dodgers, and then went to the World Series, and I tell you what, it was. I mean, we were on the third base side, a little ways up, and it was just incredible. I mean, it was because they had 30 seats and we could only take 10, because of COVID. But the food was great. The people working were thankful. We were there, but also too, the weather and just the ambiance of the atmosphere there was just really, really great. Look forward to the Ranger season.
Yeah, well, and also back when we were going there, I was looking at some nice deals going into 2020. We were talking about getting this suite. Now it's like, can you send some more stimulus our way? So it's funny how things have changed over the course of the year. So I want to get you back on. So we've had you on, I don't remember when it was, and we talked about the price of oil. We had Robert on last week, talk about the price, and obviously with Josh out today, we brought him on to help as well. Just talk about the price. What are you thinking? I'm thinking the price is a little bit overinflated, at least right now. What are your thoughts as we wrap up 2020 with the price? I said it would go, this is back in December, I thought it would go below 35. I thought we'd have a big sell-off. We're seeing a little bit of sell-off this morning. I thought we hit below 35. What's your thoughts on the price? It's at 47 last time I looked this morning.
Yeah, I mean, it's down $2 today. But, I mean, we're going to 50 plus until, today. And I know that, demand and – I mean, everything's about supply and demand, right? Mm-hmm. It is about supply and demand. And our country needs over 20 million barrels of oil a day. In the United States, that's our appetite. That's how much we need. I mean, that's not us, gobbling up more. That is our need is 20 million plus. We were producing 13.6 million a day before pandemic. Rig count goes down, shale wells decline, people cutting wells off. I mean, it went to 10, and it's going to go below that, you know, so it'll continue to go down, our production. So we need 20 plus. We're making 10. 20 minus 10 is, still need 10 from foreign countries. And then when the demand comes back and we need 22, 23, like where we were before the pandemic, you know, you need 23 million and you're making 9 or 8. There's a bigger discrepancy there. And that what's going to happen there is they're going to say, wow, Saudi Arabia and Russia, they planned for this, right? They planned for this, you know, difference of how much oil we need. So therefore they're going to go, man, hey, we'll sell it to you, but it's going to cost you, you know, because we forget how these countries make money. You know, these countries produce a lot more than they need. It's not like the United States. You know, we've exported some because our refineries can't help it, but you know, we don't produce, you know, we're not energy efficient or energy, what do you call that, Robert?
Independent.
Yeah, we're not. I mean, that's what people go, I mean, this senator asked me one time, he goes, well, how does it feel to be energy independent? I said, hey, man, unless somebody can do some math for me, and unless things change really fast, we're not. I mean, we aren't, unless we lose half our demand or something.
No, I think you make a good point, Jay. And it's just something that's another one of those things that everybody talks about, energy independent, and how that, you know, puts us in a much better spot. But just to your point, we're not energy independent because the refineries can't process the oil that we produce in this country. You know, that's the primary reason we're not. We're making, in terms of volume with the light sweet crude, more than we need, I guess you could say. But ultimately, we can't even use it because we can't refine it in our own refineries. And, you know, the EPA regulations are only going to get more stringent and more difficult over time. So revamping and upgrading these facilities to be able to take some of our domestic crude is going to be a tough sell, especially in the Biden administration. So again, where does that leave us? And to me, it goes back to the political aspect of it, where we talk about how we're energy independent, but really and truly, we don't have a lot of control over that because you're still subject to OPEC whims, right? OPEC and some of the other Middle Eastern countries, they theoretically decide what the price is going to go and what they're going to do. We just can't all of a sudden say, you know what, we're gonna send our oil to the refineries and we're going to refine our with our own oil. That's just not going to happen.
Right. And if you don't have it, and they have it, and they're not going to do you any favors, right? I mean, they're not going to just go, oh, well, I'm sorry, you guys don't have enough oil. Well, because this is what happened back prior pandemic, was they wanted to flood our markets because shale production went from 5 to 13 million a day. 5 to 13 million was all that shale, S-H-A-L-E, in the Permian Basin, you know, the other places that you have shale, and it just increased so much, and then the price was going up, and that what helped. And then all of a sudden, they know what the cure for U.S. production to go down is low oil prices. And how do they do that? By flooding our markets with oil. There was tankers off, you know, the Hudson River and the coast of California. There's all these tankers hanging around going, oh, hey, we need. I don't know how much of that was show, but I mean, it did show that, hey, you know what, we didn't have enough oil, and this is how they make money. These countries, Nigeria, Saudi Arabia, I mean, that's how they make money for their countries, is by selling oil, and the higher the price, the better for them.
Robert's talked a little bit. I'm curious from your perspective, how concerned are you about the money in the U.S. Leaving the industry and not wanting to come back, maybe ever, or at least for the next 2 to 3, 4 years? What have you been hearing from the money folks?
Yeah, I mean, it's tougher now than it ever has been, and it will be. I mean, you hear that hundreds of billions of dollars that was spent in the shale will never get their money back, 125 billion or something crazy. But I mean, all this money was spent, and all of a sudden it's stuck in this shale. Now it's sitting here going, okay, well, where's my return? It's not there. But the best cure for low oil prices, is what?
Low oil prices.
Low oil prices, right? So
Absolutely.
the lower oil prices go, and all of a sudden people are going to go, oh my gosh, we have oil, so oil prices go up. And then, because I mean, banks may be saying that right now, but man, when they get a taste of $60, $70, $80 crude, they may be going, yeah, I know I said that, but let's go ahead and deploy some capital, you know, because we're not going to see it. You would think that, and I was mad at Trump for him allowing these foreign countries to flood our markets with oil. And you would think that we would be smarter about this, about what's best for the U.S. economy. You know, it's not $20 oil, nowhere close. You know, it's not $100 oil, nowhere close. There's got to be somewhere median in there that says, you know what, this is healthy for everybody, and we're not spending, you know, $6 at the pump, but we have a good trickle down theory, because, you know, one rig may spend $100 million a year in the economy, and for you know, I mean, talking about bars and restaurants and dry cleaners and donut shops. And I mean, man, when we're drilling, we had a couple of rigs running. I mean, we were like, man, I mean, we're buying we're taking, money and just, you know, spending it like no tomorrow in these towns. That's what they need. You need this.
Well, you know, like to your point, Jay, one of the things I was telling Ryan earlier, and I don't know if we got to it, but when you start looking at the rig count, the majority of the folks out there with the rigs today, I'm looking at drilling info right now, you know, on the maps, and I'm seeing the EOG sitting at 22, Pioneer at 13, Shell at 13, Chevron at 11, Oxy at 11, Concho at 10, then ExxonMobil at 10. And then after that, you just have a bunch of small companies coming in. Well, not small. I mean, you got Chesapeake and Atheon and those groups. But I'm saying most of the guys that are running the rigs right now are public companies, right? And their dollars and their cost of capital is much different than the private equity backed companies. So, you know, I was going to ask you what your opinion was on how does private equity handle this going forward. I know that model has dramatically changed, but how do you see that changing in the next couple of years where, you know, you had seemingly unlimited amount of capital to put to the space, and now they seem like everybody's pulled back?
Yeah. And I think it's going to take a long time for private equity to come back. I mean, your institutions, because private equity, that's what drives private equity, is the institutional money, right? And if they're not getting the returns that they they've been accustomed to back in the day when all this brand new started. I mean, when all this started back in the day, I mean, you know, Ken Hirsch at NGP and even before that, I mean, this is what, you know, started all this, and they gave the institutions what they wanted with the write-offs and not necessarily the write-offs, but the depletion allowance, but they gave them these very, very healthy returns, and you're really not going to see it for a while. Now, will it come back? I don't know if it'll ever come back or not, but it won't come back for 2 to 3 years. I know that. You know what I'm saying? I don't know if we're ever going to have a healthy NGP model where they're, you know, raising a $6 billion fund, they're spending $200 to $300 million per company, and I don't know if that's ever going to come back because of people that need that size to build again, you know, because of everybody making changes. But also know this, you know, it won't come back anytime soon if it ever does, because I mean the money is what drives that whole entire market. Well, will there ever be companies that need assets? Yes. What we do is we just raise money for one project instead of 20, but you know, people will need our product. Public companies still need our product, but it's just not on the scale when you have 5 to 6 different private equity firms raising these $4, $5, $6 billion each. You know, that's massive.
Well, when you have that level of capital destruction over time, you know, and it's not any one person's fault. It's just a number of things that are outside of control, right? We're in the capitalist environment here in this country, so that every man for himself. But when you get that kind of capital destruction, then you're gonna be a little bit less. You're gonna be less likely to invest as a pension fund or a money manager or so on and so forth. You know, I can't remember the exact numbers, but at some point we had probably 10-20% S&P 500 in oil and gas, and now it's materially less than that. And so the investment into private equity funds, from what I understand, is quite a bit less than it used to be as well. So even if you invest as a money manager, as a pension fund manager, insurance manager, endowment manager, you're investing into a fund, and let's say you put in 2 to 3% of your fund into energy and oil and gas, specifically upstream. Even if you hit a home run and 3x and 4x it doesn't really move the needle for you as a fund manager. And I think that's the challenge that we're up against as an industry.
Exactly. And, you know, all of that does, if you'll think about it for a second, what if you have that many funds and that much capital going toward drilling wells, because they drill, what they do is they acquire an asset, they drill it up and they divest, right? That's ADD model. It's kind of like what we do. But they have 20 different companies. So there's 120 companies that need these assets, big assets. And if they're not drilling, what's happening to our supply? What's happening to our supply in the United States because of these 120 companies not getting 2, 3, 4 rigs? What's happening to our supply? What's going to happen? You know, JP Morgan, you know, called back in April. They said, hey, oil prices are going to go negative. You know, and I'd have bet everything I had that prices weren't going to go negative. I mean,
you and everyone else.
Man, my great grandfather would turn in his grave. I mean, you know, unbelievable that prices would go negative. JP Morgan said, hey, it's going negative. It did. Now they're saying that there's a great chance that oil will be at $190 a barrel. 190 in 5 years. Well, maybe 4 or 5 years, 4 years down. You know, so what they're saying is that there's so many people that are going to be out of the market, you know, out of the market, not drilling for oil. So our supply won't be there. When our supply is not there and the demand's there, what's going to happen to the price of oil? I mean, here it goes, right? So you're seeing exactly what JP Morgan, but exactly what economics is all about. Now, my brother graduated SMU economics. I mean, I wasn't the economics guru like my buddy Ron Ray, but you know, but I'm just saying supply and demand. I understand supply and demand. And if you don't have the supply, but you have that demand, you know, there's going to be electric cars. Yeah. 5, 10, 15 years ago, or 5, 10, 15 years from now, that is going to make a difference. That will make a difference 5, 10, 15 years from now. Today, no.
And that's what we're talking about, Ryan, to start the show. When you asked, you know, why I thought the prices go up, and you know, we talked about when are we talking about going up? Are we talking about in 6 months? Or are we talking about in 5 to 6 years? And so ultimately, it's that. I mean, we really don't know where we're going to be even in 3 years. You know, so I agree with Jay, and I think that the supply is gonna come down. You know, the decline rates on some of these wells that we've quit drilling and the ones that we last drilled are really, really high. And so with COVID, you know, I think the COVID recovery and the delay there potentially is masking the supply demand balance. But is that going to be at the end of next year? I don't know that, you know,
right.
But,
well, yeah. And so I agree with the long-term oil and gas thesis. I mean, I've made that publicly clear for years and years and years now. I'm not, so I'm looking more short term. Like I was telling Robert, you know, looking at it from a service side thing, you know, companies got to survive until next year. And the more companies that go away, then the quicker this problem you could see. Of course, we got to figure out, you know, China has a huge SPR. And so, you know, how will they put those barrels back onto the market to control the price? There's a lot of variables that none of us can sit here and figure out how they're going to play out. But one thing that I want to let you go with this, Jay, you know, Robert talked about, when he was mentioning the return that you get, and until the tech companies kind of have their bubble burst again, and these IPOs, these overvaluations, if you look at a lot of that stuff, that's a lot of fake money, in my opinion, going into a lot of those tech bubbles. We need other industries also to kind of have a pullback so that the returns that you can get when oil and gas is done well do look more attractive, and that's nothing that's kind of out of our control. But will oil and gas be responsible next time, or will we go back to our old ways? That's the joke. Just give me one more oil boom, and I promise I'll save my money. Will we save it our next time, Jay?
Oh yeah, absolutely. And I do believe that. I do believe we're going to have another good bump in oil prices. You know, and I would recommend to everybody. I mean, it's not going to happen forever. I mean, my family's been in the business 100 years. My great grandfather had 12 kids. Everybody's in the oil business, you know, and man, if you're a man, you're in the oil business. If you're a woman, you're married to somebody in the oil business. And so we have a lot of oil and gas people, and we've said that time and time again. Don't know how many more cycles we're going to have. I do know we're going to have another one. It's not going to, it's a supply and demand issue. You can't tell me that the demand is going to go down as fast as our supply is going to.
Yeah. So really what we're saying here, I think, is when do we get back to 100 million barrels a day? None of us know that answer. It probably won't be next year. It might be 2022. 2023, I think we're safe. We probably all agree by that point we are there, if not sooner. And then beyond that, when you look at Africa, emerging markets, and you look at their GDP, and if you assume that they're going to have any kind of exponential growth or decent growth, the global demand for oil will exceed 100 million barrels today. And in this time period, if you're not putting oil into supply or oil on the market, you're going to see the price get out of whack. And so that's kind of the
capital's dried up, right? And that's the problem here, is that we're no longer putting capital. But like you notice, I just mentioned to you the number of the companies that actually have drilling rigs out there. They're all public companies. So for some reason they have the ability to do that, more than private companies. But you're right. The supply, I think, is going to suffer in the near term, not in the next year, maybe not next year and a half, but look out, 2-3 years from now, things are going to be potentially materially different. And, who's going to be the ones in business still at the time? Because I can tell you right now, there are many companies that are not going to be able to make it for 2-3 years.
That's right.
So we'll see.
Okay, Jay, listen, I know we're up against the clock here. Tell folks where they can find you. I know you got a picture of your book in the background. I've got a copy later on here somewhere. King Operating, where can people find you? Where you want to put them to? The Jay Young Show. I've heard you've had a lot of decent guests on the Jay Young Show, but you haven't really got the A-listers on. Just want to throw that out.
I'm saving the best for last. I'm saving the best for last. I've got a list of people, and I need. You're right. I've been thinking about how to get more quality and better quality, and that's where I need to go. I need to up my game with you guys. My book is Texas Upside of Oil and Gas Investing. It's how the investors, $100,000, $200,000 invest wants to get involved in the oil and gas business, and what's a good deal, what's a bad deal. I tell you about it right there in my book, Oil and Gas Investing. That's actually there because I have my bathroom door right behind that, and if you don't see that, I was like, okay, well, man. So, but anyway, it's my office. But so jryoung.com, kingoperating.com. I've been in business for ton of years, and like for you to come on, and if you do come on, you will not be on the Jay Young Show before Ryan Ray. I guarantee you that. Okay, so call me, beg. Robert, I'm sorry, man, I can't have you on the Jay Young Show before.
No, I'm perfectly okay with that. But since I'm talking to the man, the myth, the legend here, the author himself, tell me where I need to be. You say the upside investing. Where do I need to be looking if I'm in the market and I'm looking to buy assets right now?
I don't think in the Permian. I mean, we're in Colorado with an asset that we have, and vertical wells, that would produce 40,000 barrels of oil, and in the Permian produce over 150,000 barrels of oil because of there's no shale. That's what the Permian Basin is, this shale, SHALE, and wells just don't make that much oil. But up there it does, so you need lower break evens. And that's why we love the idea of the oil and gas that we have in our Colorado asset. So I love Colorado. I love natural gas for next year. I think that's going to be great. I just don't. It's hard to drill for wells and make the break evens that you need in the Permian Basin.
Jay, thank you so much for coming on. Thank you. It's always good to get you on. You're always gracious with your time. We appreciate it. Merry Christmas, Happy New Year, and we'll get you back on sometime next year. Talk about what's going on then.
Thank you, Ryan. I appreciate that. And Robert, very nice meeting you. Merry Christmas.
Likewise. Merry Christmas.
Thanks.
And that was Jay Young with King Operating, a friend of the show. Good guy. Good to have him on. Robert, that is, I think, a wrap for this episode. Wish you and your family a Merry Christmas. Thanks for hopping on short notice and doing this. It seemed like you and Jay had a lot of fun talking oil and gas, and so maybe we should do that more often.
It's great. It's always good to talk oil and gas with people, especially now when, like we said earlier, nobody knows what's going to happen.
That's right. So, all right, brother. Well, Merry Christmas to you and Happy New Year to you and your family. And I'm sure we'll be talking now that we're officially friends. That's good to know.
All right. Sounds great. Merry Christmas, everyone. Thanks.
Listeners, thank you so much for tuning in. And until next time, keep climbing.